SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi Meet the Author e-lecture. Today we will discuss a new book by Livio Stracca from the ECB on redefining the monetary standard in the digital age, which was published recently. The book explains the economics of money in a digital world in plain language, but based on sound research and long policy experience. It covers limitations of the current monetary system and what needs fixing. It explains the universe of decentralized finance with a special focus on the blockchain. It discusses the future of money and monetary policy in an increasingly digital world. To conclude, the book offers scenarios and predictions on the monetary future and outlines a vision for money in 2050. In this context, it also explores the consequences of entirely replacing physical cash with digital forms of money. We're extremely pleased to have the author, Livio Stracca, Deputy Director General for Financial Stability of the ECB, with us today. Livio will start out with a 30-minute presentation of key findings from his book. Then, two outstanding experts will offer their own take on these themes. A big welcome to Stijn Claessens, Executive Fellow at Yale School of Management, and to Christian Pfister, Economist and Consultant in Digital Currencies, as well as Associate Researcher at the Université d'Orléans. Without further ado, over to you, dear Livio.
Thank you, Ernest, and thanks a lot for the invitation to present. I often attend these seminars, so I'm happy to, once to contribute actively. You mentioned my ECB affiliation, but, this book is really not, part of my, core ECB activities. And, also I'm kind of solely responsible for the views, expressed. And it's very important, the ECB does not pay too well, but I would not like to lose my job. I'm kidding, of course. There is nothing particularly incendiary in the in the book, but it's really, the views are personal. The book was published in last July by Springer Nature, and it's available in Amazon and other outlets. It's also very fairly priced, so for those who are interested, it's good value, I think. So let me start generally by saying that, this I believed already, but, writing the book, it became even clearer that so what we have been taught in university, that money is neutral and there is a veil, and basically only determines nominal values, without really kind of influencing the real part, the real values of the economy, is not really true. So it is certainly at the intersection of almost everything that matters. It's not always necessarily, in a causal way, but it's in the middle of the action for sure. And this, concerns, a number of things that are really crucial in today's society, and even more so with digitalization. So you can think of rule of law, you can think of social cohesion, you can think of privacy, very important in the digital context, and democracy. So so monetary choice is not, independent of those variables. And even though this is not necessarily, causing those, it's certainly tightly connected to them. And this is, a feature that is very important. So, so the book has these, 7 chapters, and don't worry, I will not go through them, in detail. So it has an introduction. So the first chapter is about understanding the current system. I mean, there are a lot of misunderstandings about already the current system. So I try to make some clarity about. I mean, this is also based on conversation I had with economists, non-economists, and so on. And I try to put a bit more clarity. And the third chapter is about digitalization. So what does it mean to be in a digitalized setting? What is a digital market? What distinguishes a digital market from a non-digital market? The fourth chapter, which actually initially I hadn't planned, but was suggested by a reviewer, because only one very good thing of the Springer editor is that the proposals and books are reviewed. So you have to. It's a bit like a journal publication. You need to reply to reviewers, and so one reviewer was very much in suggesting that we need a chapter on cash. So do we still need physical cash? And then there are the two following chapters are maybe the most kind of new. So the first is about currency competition. So is a digital form of money kind of reconsidering the pros and cons of having currency competition in the spirit of Friedrich Hayek. I mean, I will talk about that later. The following chapter is revisits an older concept that, in my view, has relevance in the digital age. So more than before, which is the to create index units of accounts. So to try to put monetary policy on an autopilot. So to try to make monetary policy a more automatic system. And the final chapter is about a lot of properties that we would like to see in say 2050. I mean, I chose 2050 just to say in the kind of the future, and also what are the trade-offs, and it's avoidable and avoidable trade-offs between different properties. So there is a wish list of properties, but we cannot have necessarily all properties in the same way, and there are conflicts between different. And I will touch upon that later a bit. Part of this kind of motivation is to know that. So I've been working in monetary issues for a couple of decades, and this is probably the most interesting time that I remember for monetary economics. I mean, we did have the the Great Moderation, so the conquest of inflation in the mid '80s, and so we have been living this regime since the mid '80s. So we did have the zero bound coming after the global financial crisis. So this was a significant change or a significant innovation. But perhaps now we have digitalization and AI are progressing at breakneck speed. We had competition from cryptocurrencies, which we didn't have before. So I think that especially in the area of payments and considering the minimum exchange function of money, this is a particularly, I think, interesting and unique time. Of course, we have to discount the fact that we always think that our times are special. So that is a counter argument. We always think that our time is more special than others, and often it's not. But I think there are some arguments to say that. So I find in general, monetary economics is a very confusing concept, and it's sometimes hard to grasp. So here, I try to simplify it as much as possible. So what this monetary economics in brief is about, you need an exchange of money because barter is inefficient. So you need to decide what to exchange. So you need to have like an asset. And the valuation of that asset can be seen as a unit of account function. So the unit of account is a question of essentially asset valuation, and then the other part is how to exchange that asset, and this is the minimum exchange function, which is related to payment systems. So in theory, so we think of those going together, but you may also separate the two, and this is what I will talk about later about the so-called Eisler proposal is to separate these two aspects, but of course there are strong synergies between the two as well. All happens in a context of strong network externalities. So if a defining feature of money is that really you can have only one or two assets circulating, because the network externalities are very, very strong, probably stronger than in any other domain. Or maybe language is another example, but certainly, they are extremely strong. So it's a decision that lends itself very natural to natural monopoly. So, and also this is sometimes I find often kind of misunderstood. So, okay, so perhaps I jump over this slide. So there is a chapter, as I said, on the fundamentals of the current system. And so in which system are we living now? So how we define the system now. So I would argue that the key actor, speaking of we of payment and minimum exchange, is bank deposits. It's in most in most economies eventually we pay using bank deposits. So credit cards are simply a way to mobilize bank deposits. And so it is a system which is built on fiat money. So fiat money provides a unit of account function, but the minimum exchange is provided by bank deposits, and the fact that bank deposits are convertible into fiat money, it what keeps this whole system together. So you have these two systems joined, and the kind of the liaison between these two parts of the system is given by the convertibility of deposits to fiat money. And so the book also has a bit of a crash course in payment economics. So, for example, it explains how if you were to design a payment system, how do you ensure that it's accessible, it's secure, and how different means of payment may fare actually in this kind of trilemma. And one interesting point is that cash is once you look at be more carefully, cash has very good properties. And for example, cash is the only means of payment that escapes this payment trilemma. Emphasizing in the literature, the only problem with cash is that it's inconvenient to use, but as a means of payment is actually quite efficient. And part of the explanation of the current system is then to explain how come that an intrinsically worthless form of money, which is fiat money, came to dominate the monetary system. So how the conquest of inflation happened, and why commodity money has not performed as well as one could have imagined. So on the idea that commodity money is not ideal, so I mean we still hear now proposal to go back to the gold standard and so on. I mean. Yeah, so maybe fringe, but we still hear that, and so it is it's been quite well known, and I think that the book has some references that commodity money is not a good form of money. It's quite unstable, and this has been known for many decades or even a century. And the reason is that there are commodity market specific shocks that matter. So if you have, for example, gold, which is shown in this chart, gold is also hit by gold market specific shocks, and these are bad for gold to be a good monetary anchor. So you want something that is not subject to idiosyncratic shocks. So I argue later in the book that the proponents of Bitcoin, should have read this evidence and should not have thought that gold is a good monetary anchor, because it has been known for many decades that it's not. But of course, the counter argument could be that, okay, but commodity money may not be ideal, but it should be hard to keep fiat money stable because it's intrinsically worthless. So here, okay, so the book has quite a big discussion on this. So first of all, so what I argue that the concept of intrinsic value, is constant dependent and depends a lot on legal and institutional settings. So. My father used to argue that having real estate, is better than having financial assets, because the real estate is physical. So there are bricks you can touch, and while financial assets are a piece of paper. But I mean, I used to answer to him that even I would say the value of the real estate is not really in the physicality of the real estate, but it's more in how the property ownership is recorded in a registry. So in the end, the source of your value is in a piece of paper that is in some government office. Even though the real estate by itself has some physical form. So what is really intrinsic value is more complex than we kind of tend to think, and depends a lot on the institutions. But it is true, however, that fiat money is or may be subject to rational bubbles. So it's a bit like controlling a horse that is stronger than you. So you cannot, by brute force, you can always. So you cannot really easily control fiat money just by brute force, even using the Taylor rule. I mean, I hear some people say that. By using the Taylor rule, the central bank is able to stabilize the value of fiat money, but even that is not possible. That's what has been shown already in the 80s by Opsal and Rogoff, that is always if the private sector is convinced that there will be hyperinflation, the central bank, even a central bank following a kind of a Taylor rule, cannot stop it. It could stop it. The government can stop it by imposing price controls or other kind of extreme forms, but just monetary policy cannot stop, a self-fulfilling inflationary prophecy. So there is nothing in fiat money that makes it, kind of stable. So the fiat money, non-fiat money is essentially a coordination problem. So we agree as collectively on a specific value or path of value, but is a matter of convention, but is not that different from other forms of legal institutional aspects. So there is a part of the book that explains how we conquer inflation. And I mean, probably most listeners will know that is about the Taylor rule and the central bank independence, all the institutions we had developed in the 80s and the 90s to keep inflation low and stable, which has been a great success. So it is argued that the great moderation equilibrium is a key achievement and can be seen as a technology that we have available now to control inflation. So one aspect that I emphasize, I go quickly on this because this is well known. I hope you can still see it. Yeah, so one key innovation that is a bit underappreciated, I find, is a paying interest on reserves. So it's a key innovation, and so this allows the central bank to control both the interest rate and bank reserves. And so in theory, the central bank in this way can pursue both price and financial stability. So I don't have time to go into details, but I do find that this is, has become now one of the, together with the other elements I mentioned before, a key feature of the current system. So, but in spite of all these successes that central banks have had, not everything is perfect, or I know that. So the zero lower bound problem is still a threat. I don't think we have fully solved the zero lower bound problem. So we know the Taylor rules that somehow central banks, appear to want to follow or are believed to want to follow. So we know that they have a lot of perils and traps. But generally, I think I would argue that the biggest issue is the low controllability of inflation. So the Phillips curve, almost everybody knows that is uncertain and probably not linear. But even equally important, if not more important, also the IS curve is very uncertain. Those of us who have tried to estimate, the IS curve know that is a very fragile concept and it's really hard to find, significant coefficients. And of course, R star is highly uncertain, as we all know. Another interesting aspect is, central bank independence. Of course, everybody believes that central bank independence is important, and it is probably important, but it just doesn't come out very correlated with inflation outcomes. So maybe it's a measurement problem, but the evidence of central bank independence does not jump at you, in a scatter plot or anything like that. Okay, then we move to the chapter of digitalization. So the chapter describes the feature of digital market, what is a natural monopoly, the idea of increasing interest of scale. I mean, one interesting aspect that is discussed is also how networks and externalities make demand curves upward sloped. So meaning that higher price means more demand, and then the whole question of privacy. But all this digitalization has also led to this decentralization agenda. So the idea that you can create a financial system without intermediaries, just as a libertarian idea of a fully decentralized system. And so this is the concept of tokenization. And again, I don't have, of course, the time to go through it in any detail, but I mean, in general sense, what is tokenization is, it means that the value of a given asset is unrelated to the identity of the transactors. So like in physical cash, physical cash is a tokenized asset in a sense. And what is the difficulty, in kind of applying the same concept of cash to the digital world is that digital files are easy to copy. So while if I give you my banknote, my banknote leaves me and reaches you. If I send you, a piece of paper by email, I can always keep a copy of the document, and this creates promising payments because it allows a double spend and other undesirable features. So the whole agenda of tokenization is a bit to reproduce this kind of finality of payment independent of the identity of the owner in the digital space, and with the objectives of bringing transaction costs down, possibly democratizing finance. So there is a kind of libertarian kind of undercurrent in this, and also making programmable money possible, which I'll say a few words about. So the book explains a bit what is behind this decentralization agenda. So in a sense, it's a bit like maintaining a spreadsheet of transactions. So suppose, I make the example of, think of for example, a village where the inhabitants want to keep spreadsheets of past transactions. And also this is it's a great idea, but it's hard to implement, mainly because of the double spend problem. So I always have an incentive to tinker with the spreadsheet in order to make sure that my financial position improves. And if everybody has the same incentive, in the end, this will not work. And you can see that. So the 2008 Bitcoin white paper is actually a clever, innovative solution to this problem. So how can you have a self-maintaining record of transactions where the double spend problem does not arise? So in other words, you have no incentive or no possibility to cheat on the past record of transactions. So I think so. The blockchain is an innovative solution, but there are two main problems. So first, the proponents of Bitcoin got the token wrong. So they try to model the Bitcoin value to gold, and they were thinking of creating a digital gold. But as I explained before, gold is not a good monetary anchor. And what they should have done, they should have pegged to the CPI. So I think if they pegged Bitcoin CPI, they would have had much more success. And second, there are also fundamental doubts about blockchain scalability, and I'd say a few words about it. So this chart is about, but that Bitcoin is very volatile, and it's too volatile to be a form of money. But what is interesting also is perhaps less known is that the Bitcoin paper introduced this quite odd system called proof of work, which for those who are kind of enter the crypto world, it looks very strange and suboptimal. But this is actually, once you look into it, is actually needed, and the logic of this is a bit the same as spam emails. So if it is costless to send emails, you get spam emails. So you need to be able to create payments that are truthful, and this can only be done if it is costly to create those payments. And so it's a bit like in the book I kind of make the comparison with a doomsday machine. So you need to credibly promise to end the world, so to create a huge cost if you want to. So if a criminal or somebody wants to tinker with the record of transactions. And so if this is true, this means that the DLT, so the decentralized ledger, is fundamentally not scalable, and there is no technical fix to a lack of trust. So it might be, however, that more intermediate forms of decentralization, so proof of stake, may turn out to be scalable. So this is what we are seeing a bit now. So I think the industry in general has abandoned the idea of kind of perfect, but there may be kind of intermediate cases, maybe based on proof of stake, that they may actually be workable. In the book, I described, what the attempt. I mean, knowing that the Bitcoin price is not stable, so the attempt to add stability to this so crypto assets, and you can see stable coins, CBDC, and even tokenized deposits as a way to still be in the world of blockchain and DLT, but kind of correcting the mistakes of the original coin that was introduced. So there is the usual amount of discussion on stable coins. I mean, programmable money it's interesting because it's potentially a significant benefit of tokenized forms of money, but they are also, and it's interesting, they are difficult to do in the current system. So in the current system, making conditional payments is hard. And this could be a key innovation of decentralized systems. But there are two main concerns. So the one is a singleness of money. And on this, I'm relatively skeptical in the book. So I think it partly is a semantic issue. And also which rule of law to apply. So if payments are done, somewhere in the internet, which is the rule of law that applies. So, okay, I jump over this. Okay, so let me say just a few words about the chapter on cash. So, the bottom line, I mean, I review basically evidence on whether cash is declining. And I mean, compared with my prior, I found that so cash is declining. So the conclusion of that chapter is that we still need cash, but more as a backup. It's a trade-off because if you need cash as a backup, you need to still use it. So it's going to be hard to have cash as a good backup if we never use it. So the conclusion here, we cannot completely part ways with cash. And in spite of its undesirable properties, we still need to have it and to use it. So this is about the decline of cash in Europe. Okay, now the last kind of two chapters. So one is the idea that should we I mean, given what happened to crypto and the new forms of money, should we revisit what Friedrich Hayek said in the 70s? That is better, desirable to let currencies compete. And this has been refuted by economists for a long time. So anyway, there are also modern papers on this. Is the idea now needs to get new life? So you can look at the international environment and say, okay, is this a test of the theory of Hayek? So the answer is yes and no. So it is true that we have this free competition, but so we ended up in essentially monopoly of the US dollar. Is it better or worse that we have the dollar as an international currency? It's hard to say. It's there may be geopolitical reasons, but just in terms of monetary stability, I mean, global inflation, it's not clear that there are better alternatives or worse alternatives. So it's hard to judge from a welfare point of view. But so I basically argue that Bitcoin is not been highest vindication, but healthy competition is still a good argument. And there is no impossibility theorem that a better form of money is not possible. Final part of the book is Irving Fisher's compensated dollar proposal. So this was proposed by Fisher in 1913 in a QJE paper. And the idea is to make the purchasing power of the dollar constant. And what I argue is that this could be considered because it's very well attuned to the digital age. So I jump over the Adler proposal. So the idea is similar to what is done in some countries with these index units of account. So in Chile, you have the Unidad de Fomento, which is an asset with a constant real value, which you can be seen as an index unit of account. And this is updated daily. And it's also security that can be traded. So what could be a new monetary policy of the digital age? So I argue that separating the medium account and medium exchange functions is inefficient because there is a synergy between the two. On the other hand, the current system is one where, yes, monetary policy works and the current system works well, but there are some limitations and inefficiencies. So what could be a possible solution in the spirit of Irving Fisher is to create a market for an asset with a constant real value, like the Unidad de Fomento, and define the monetary standard in terms of that asset. And this is easier, it's important, with a digital form of money. And this would lead to enjoy price stability by design. So with that, I mean, I go through some problems with this approach, but in the interest of time, let me stop here, and very much looking forward to discussion.
Thank you very much, Livio. Quite a rich presentation, quite a few controversial proposals there. I'm sure we'll have a vivid discussion. Let me now invite Stijn for your comments.
Thanks very much, and a pleasure to be talking here. So, a lot of praise. Livio's book really covers a lot of things here. He didn't have time, obviously, to present that, so it's a good read, and I recommend it to everybody. I largely agree with analysis and conclusions. We have a kind of a debate as we go along to 2050, 25 years from now, in Livio's book. Do we need to support the current paradigms? What needs to be changed? I will get into it. I also will mention along the way that there are lessons from other countries that are in some sense already farther ahead than we think. So 2050 is maybe not that far off for them. A lot of friends talk about it, where both retail and wholesale, but the competition part of it is a difficult one. The disruption can come in several ways. The policy response will have to vary accordingly, depending on how much disruption we're going to get going forward. But again, that covers the same areas. Let me start by going back to the basics here. As Livio mentioned, we have these three roles of money: unit of account, means of exchange, and store of value. As Livio said, there's a lot of interaction in between the two, but each of these markets nevertheless has its own industrial organization and its own market failures. So let's take the means of exchange, where we'll focus on a lot, the payments part of it. We're talking a lot about a two-sided market that we don't see the same way in the store of value. So that alone gives rise to different externalities and different problems. More importantly, in the context of this book, is where digitalization will show up first. And I think we see that mostly in the payments part. And that's the easiest one to digitalize. It's really about distribution payments. And there we've seen in other sectors as well, a lot of change, whether it's music or information or you name it. What does that mean? Well, let's talk about what the evolution means on the retail and wholesale. I think largely it's a process ongoing. Unless we have excellence, unless we keep not the industrial organization intact, I'm talking here about dominant actors, the public sector will work it out with the private sector, because we do need a two-tier system to maintain. On the wholesale, it's even more so the case. We need to think harder about financial stability. But again, the supervisor in the markets, I think, will work on a robust and resilient system. So evolution is the buzzword here. That doesn't mean that the competitive landscape is not a worry. Go back to how large the market is. It's about 1.2 trillion revenues in the global context, half retail, wholesale. And there's a lot of economies of scale where you can see large, it's not necessarily large GSIPs, which already spend a lot on IT, but it's also the third parties, the global cards. There's a lot of potential for dominancy here. And this is also where the big techs so far have been out of it. But if they were to come into this business, it really would be a risk of oligopoly. Now, what does it mean going forward? I can't predict it. I can go back to my own paper that I wrote 25 years ago. And this is thinking 25 years ahead. Is it actually feasible? And I realized that this chart is not so bad. It basically shows the entry barriers disappearing in some segments of the industry and the ease of commoditization improving. So we see a strong trend going towards that upper quadrant in terms of low entry barriers, high commoditization, and payments is the typical example today. But there is this risk of this backlash. We move temporarily to this high commoditization, but then we go back to high concentration, high barriers to entry. And this is my worry for this sector. Let's go to the disruption. I think disruption is by definition very difficult to predict. Cyber is one where I think we're going to have to worry a little bit more. It's number one for most CEOs. It's in the background, but as it becomes state actors and geopolitical, we have to respond by more public action to deal with it, almost an arms race. The AI part of it, I'm less clear what it all is going to mean. I think most of us don't know necessarily. but the unexpected effect then by definition are going to be more there. So again, we would need public action, which to date we have seen less. So I can see some disruption also in the role of money, and Livio alluded to it as well. The more immediate disruption that I can definitely already see, and we have to deal with it now, is crypto. This is the Bitcoins of the world, and the stable coins. Crypto is growing fast, is being legitimized by some, but the value, as Livio points out, it's not money, it's not working as a payment system. The stablecoin, however, is a little bit more tricky. It's legitimized now in some sense by the rules put in place, but they're not all stable and they're not always yet functioning in other parts of the system. So this could have a confidence crisis with adverse effect on the singleness of money. This is a disruptive force that could be quite significant. Combine that, and this is the currency competition issue. This in the normal world is already tricky, but if we have these trade diversions and other fragmentations where we can diversify less risks, the currency competition is another area where I could see disruption rather than a smooth path forward. I think many issues that we're talking about are core here around data. This is a traditional stability efficiency trade-off. This is the trade-off between access to data, whether you can get a service or whether your privacy will be compromised. There's a trade-off here. And there's a trade-off between privacy for AML and CFT with the ability to have an integral system. That area is not yet addressed by policy. So we really have a big disruptive potential here at our hands. Now, what does it mean going forward? I mean, this is, I think, where the 2050 analysis and roadmap has to be clear. I think the basics on the left are still the same. Monetary policy, I think we can do well. I mean, we don't even need the large reserves Livio mentioned for monetary policy, in my opinion, but that's a secondary issue. But key is to maintain the singleness, keep crypto out of the mainstream of my account, and keep the quality of supervision as we have it. Part of that is, however, focus more on market structure. As I mentioned, that is a global issue. It's difficult, particularly given fragmentation. A big piece of the puzzle is whether or not the big techs will be into finance or in payments first. They can easily become systemic if they were to do. They tried, it was stopped, but whether they will try again and will not be stopped, I don't know. Cyber, as I mentioned, cyber is like the equivalent of crime in a country, right? The police has a big role there. So it's not a private sector task, it's more a public sector task, but we don't have a utility or a task organized in the same way as we have for other forms of crime. Crypto, I mentioned already. I think one of the things that we should do more, and this is where the EMEs can be very useful, is develop the CBDC in a way that is building on a two-tier system. So India is mentioned by Livio in his book, but Brazil and others have very interesting models where we can learn from. And that's not 2050, that is a much earlier agenda that we need to pursue and is being pursued already. Last, data. I think the key point here is in this triology or trilemma, not to dissegment and creating bad market structures with both financial but also monetary instability. It's not an easy task, but it needs to be done. Let me stop here and pass to Christian.
Thank you very much, Stijn. Let me now turn to Christian. You announced you will focus on chapters 5 and 6, currency competition and monetary policy in the digital age. Christian, over to you.
Thank you, Ernest. I'd like first to thank the SUERF for giving me the opportunity to discuss this very timely and interesting and well-informed book. The book is on a very topical issue. It's extremely well researched and written and provides both theoretical references and practical policy recommendations in the monetary field. It's based on very useful distinctions also, such as between money and payments, with an emphasis on the role of network effects in both cases, which is in the proper approach, in my view. Also distinguishes very well between the different functions of money. And yes, I would agree with Livio, the unit of account role comes first. It's also good. It provides also a very good opportunity to read or reread classics such as Fisher and Hayek. I reread these two references actually when I read the book. Also to read or reread more modern authors such as Hall or Rice or Sims. As Ernest said, I will focus mainly on chapters 5 and 6 with two main points. Livio is, in my view, a bit too harsh with Hayek, and that's not saying that just because Hayek was born Austrian, but for other reasons, which I will explain in a moment. And I have concern about the possibility of Livio's proposal in favor of an index unit of account to fly. So regarding Hayek first, I have no intention to defend Hayek's view of a denationalization of money, but there are a few points I'd like to recall. In my view, first, there is no need to resuscitate currency competition. Currency competition is always there, and could be seen when concerns were expressed by some governments and central bankers about the GM or Libra GM initiatives. Also, it can be seen that there is currency competition just by observing that some economies are dollarized, either spontaneously or usually because they are spontaneously dollarized first on a legal initiative. Past experiences, also historical experiences, show that there is currency competition in the past in all countries. Different monies, currencies used to circulate. In many cases, because it was not just enough metal in the economy, so foreign coins were brought in. I do agree that legal currencies benefit from network effects, which make them difficult to eschew. In most cases, the currency has to be really mismanaged for the economy to dollarize. In any case, a bit surprising that Livio mentions dollarization only in the context of stablecoins. We do have some economies that are dollarized. I also find it difficult to agree with the idea that government-backed fiat money and crypto are a bubble whose value is defined by the fact that everybody else gives them value. This view that currency is just a social convention. In my view, it's more than that. Gold currency first has intrinsic value, which is acknowledged by Livio. Also, one should note that very often they were counterfeited, I mean, deliberately, not by bandits, by the government. Whereas current fiat money has extrinsic value, that is, it is backed. In the case of Bitcoin, there is neither intrinsic or extrinsic value. This is confirmed, the need for backing is confirmed by the fact that if backing of fiat money risks being lost, then there is flight from currency, as shown by Sargent in his famous chapter on the 5 large inflations. Consequently, until it has been demonstrated, both in theory and in practice, or at least in practice, that the decentralized, thus unbacked, because if you back, you have to have centralization. The stablecoins are a good example of that. At least not algorithmic stablecoins, but the other ones. They are centralized. You have to, until it has been demonstrated that the decentralized means of payment can be stable. For instance, that Bitcoin can be stable. I cannot concur that crypto assets such as Bitcoin has the potential to replace all aspects of fiat money. Relatively, I doubt Hayek would have denied the need for a backing of money, and that his big dream was to achieve a radically decentralized money. As Hayek puts it, it's probably impossible for pieces of paper or other tokens to come to be gradually accepted and used as money unless they represent a claim on some valuable objects. So implicitly, although it does not mention explicitly the word backing in his book, implicitly refers to backing. Thus, the affiliation between cryptos and Hayek, which is pretty often put forward by coiners, doesn't seem well-grounded. Finally, Hayek is very clear that his proposal to have has never been put into practice. In the same vein, you can refer to Sedgin and White papers in 1994 and 1999. All references can be found at the end of my slides. The best proxy in history would be the Scottish experience, not the US one, and this is acknowledged by Livio and also by Sedgin and White. Overall, I would be tempted to apply the impossibility theorem to the assertion that a monetary equilibrium with private monies will not deliver price stability, and that Hayek was in general wrong. I want to repeat that I'm not supporting his proposal, but it hasn't been demonstrated still that he was wrong. I move now to the topic of the indexed unit of account. Livio proposes to automatically peg the unit of account to the value of the consumption basket, as he said a moment ago. That's in the spirit of the compensated dollar proposed by Fisher back in 1913. This raises a fundamental issue and also some policy-oriented and practical issues. Fundamental issue first. Fisher reasons as if prices were set in grains of gold dollar. So his plan is to stabilize prices de facto amounts to having changes in the general level of prices, mimicking those sold in the market. However, Fisher does not mention this market and arbitrage with the US dollar, which would be necessary. In any case, one must note that any currencies set referential. For instance, the definition of a euro is that it is a euro. Consequently, the Unidad de Fomento in Chile can only exist because there is a peso. Prices have to be observed in peso in order to index the UF. And consequently, the UF, Unidad de Fomento, cannot replace the peso. More generally, any measurement is recursive. As Livio mentions, the unit of distance, that is a meter, is defined in terms of, guess what, distance. The definitions given by Livio in his book on page 134. My concern is thus that any price level might be compatible with the proposal, unless some extra constraint, such as the non-arbitrage condition that is made in Holland Rice paper, and which is standard, is introduced. I turn now to more policy-oriented issues, since what Livio proposes would be a binding rule. The issue arises of how to stabilize the economy using such a rule, and in particular, how to stabilize it in the face of a deflation risk. Livio mentions the possibility to depeg the index unit of account and repeg it to lower value versus the value of the consumption basket. But this would, in my view, endanger the credibility of the whole scheme. Instead, Holland Rice proposed to index payments on reserves to the price level while preserving IT, thus keeping some room for maneuver, some discretion in the conduct of monetary policy. They also describe the central role, nominal and real bonds, the role that these bonds would play in the transition mechanism of that policy on the basis precisely of the non-arbitrage rule. This seems, in my view, more realistic. However, the authors also reckon that their proposal does not allow to avoid the ZLB, and my intuition is that the proposal, which has not been tested yet and be compared to the actual practice of central banks, is likely to be close to what central banks actually already do, aside, of course, from ZLB episodes. This would limit, in fact, the interest of the proposal in case it is confirmed. Last aspect, about practical issues, Livio mentioned several of them, including the honesty of the price index. The issue of cash is just mentioned that. I quote him there, it would be painstaking to develop a new mindset where the value shown on the banknotes is a new index unit of account. In fact, I would suggest the opposite. Ping the value shown unchanged, and rather index the value of the banknotes on some interest rate in the spirit of Iceland. That's a minor remark of mine. And also he mentions, Livio, possible government interference. In my view, this is the most serious issue. And I would ask, how could the government credibly agree with an arrangement that deprives it from the possibility of cheating investors? If the government agrees, my guess is that it would be a strategic move, and it will renege on it when it's in its interest. Thank you for your attention. Thank you.
Thank you very much, Christian. I would now first like to give Livio the opportunity for replies. But let me weave in already 3 questions which we have in the chat. First question, is it legally possible to avoid big tax to take part in financial activities? Second question relates to Livio's proposal on the debt levels. Might this proposal help to decouple money supply from credit creation? And the third question in the chat is, what should Europe's strategy be to be able to compete in the future of digital money?
Thank you. And so both discussions were great. I mean, different, but very useful. I actually, I will go through them in more detail, after this seminar. I mean, on Stijn. So I guess I didn't disagree with anything you said, Stijn. So I think it's all I would agree with everything you said there. Perhaps in some parts, not just the emphasis in the book is a bit different from those aspects. For example, I very much agree, on your slide on data access, portability, open access, open banking, it's super important. I agree. It's just that the book, for reasons of space, did not cover. So the fact that it's not really covering the book does not mean that I don't believe it's important, but it's more like that I had this more focus, more monetary focus. Yeah, so I think everything you said, it's very well taken, very useful. And on Christian, I also find it very useful. I kind of don't disagree with you. I mean, so on the first part, probably the drafting, I did not succeed in the drafting. Speaking of Hayek approach and so on, so I wanted to be neutral and just to say that, how should a modern economist think about Hayek? So there was a reaction to Hayek after, in the 70s and 80s, and Milton Friedman and so on reacted. And there are also these new papers, including Fernandez Villaverde and so on, which, the literature has been quite dismissive. And so I wanted just to check whether, the rise of crypto is a bit of a vindication. And in that narrow sense, I found that it is not. And you yourself said, that Hayek would not have liked Bitcoin. I think I also write in the book that is the sense in which, but I don't, actually, I'm an admirer of Hayek, in other domains, maybe not in this, but in other domains. And, I did not want to disparage or add to the literature, add to the number of economists who have criticized his views, but it's more to say that, what is there any new element, to bear on this? Also because by the way, Hayek is surprisingly unknown to economists, including central banks. I always find, many of my colleagues have never heard of him, and I find it's a pity that also universities don't teach about this. And on your second point, okay, so this question of the self-referential nature, you might be right. I'm not really, the purpose of the chapter is not really to present this as my proposal, because as you have seen that I have a lot of criticism of it. is more to say that this is an important idea that should be studied more, and it should not be forgotten and put under the rug. So this is more the kind of the orientation of the chapter. Is not to say that I'm in favor of that, because I do see a lot of cons. I mean, on the self-referential nature, I have to think about you might be right. You might be right that you need an external anchor, an asset, but I'm not sure if that asset needs to be fiat money necessarily. It could be a third asset. But I have to think about that. So, okay, on the questions, whether it's legally possible to keep big tech out, probably, I would say probably legally possible, maybe not, but it's possible to discourage it. And one way to discourage it is to, I guess, to make, certainly to separate, the banking system from big tech, and to protect the core banking system. I don't think it's possible to completely exclude them. But at least I would say exclude them from the banking sector. And the European strategy on digital money, so it's essentially two-pronged. So in Europe we have mainly a problem of fragmentation. Payments. I think the currency is very solid, stable, and is actually liked by citizens. So if you think in terms of the euro as a unit of account, it's very well liked. The evidence is very clear. But if you think about the medium exchange part, so the means of payment, it is very fragmented. And so I think the idea is that to make the less, and there are some ways to do it. One way is to foster private sector initiatives. The other way is to create a new asset that is, by definition, by construction, a digital asset that is accepted everywhere, which is a digital euro. And the two roads are not necessarily mutually exclusive. There might be an element of redundancy as well, but is also that there are also synergies between these two aspects. So I think, one question we are often asked is, why is the ECB pursuing the digital euro and other major central banks are not? Part of this is also that the difference, the specificity of the euro area, the fragmentation that we have in Europe that we don't have in other areas. So this is, you always have to kind of explain choices based on the specific feature of each economy. So let me stop here.
Thank you very much, Livio. I would like to give also the opportunity to Stijn and to Christian to have a final comment. Stijn, do you want to start?
Just quickly on the questions, big tech, we have done keeping the big tech out of the payment system with Libra and DM. I think the banking commerce is a legal ways of separating it and making it more clear. Additionally is what I mentioned on the data. Data is the oil that keeps the system for big tech going. If you don't separate the data part in the banking versus commerce component, we're in trouble. The second question, debt and money, there's a relation, but it's not one-to-one. You can have debt levels without even money. In the old days we had old hundreds of thousands of years ago, a commitment to deliver a good somewhere, which was a debt without any payment mechanism in place. So money came relatively late, debt came earlier in some sense. So we can separate the two if we want to. The last part, I think it's really about the third question. It's about the rails through which we deliver the payment services, which are now controlled by the US, and that creates dependency that we don't like. The CBDC isn't do that, but there may be other ways to do it as well.
Thank you, Stijn. Christian, do you want to have any final comments?
Yeah, thank you, Ernest. I'd like first to thank Livio for the precisions he's brought to my comments. Perhaps to a few views on the issue of Europe, how to compete in the future. In my view, there is no risk of dollarization of the euro economy. We have a solid currency, we have solid financial institutions, we have efficient payment systems. What we need to do for the future would be to be present in the sector on what I call new forms of money, including stablecoins and the tokenized deposits. And for that, we should support development of euro-based, euro-referenced new forms of money, euro stablecoins and euro tokenized deposits. And we should also support the tokenization of assets, which would be very fruitful in the future, and for that allow the settlement in central bank money of transactions in the DLT environment. Whether that should be done with atomic settlement, and whether this should imply the issuance of a wholesale CBDC, I think is still open to debate, but we should go in that direction, definitely. Thank you very much.
Thank you very much, Christian. This concludes today's SUERF-BAFFI Bocconi Meet the Author e-lecture on redefining the monetary standard in the digital age. I think it has become obvious that after today's teaser, a closer look at Livio's book is absolutely worth the effort. So please get it. Thank you, Livio, Stijn, and Christian, for your excellent presentations and the vivid discussion, and to all of you for your interest, questions, and comments. Bye-bye and take care.
Bye-bye.
Thank you.
Bye.
Thank you.